Hello and welcome to the Week in Markets. I'm joined here by Joe Forward, investment analyst, who's going to talk us through the main events of this week in terms of what the market's been focusing on and how markets have performed. I suppose we're mindful that markets remain volatile, especially within equity markets, really focus on tariff risks and the uncertainty that brings to growth and inflation. So Joe, can you just talk us through what you've seen in terms of market returns and the key drivers and events?
Yeah, of course. So at the start of the week, interestingly on Monday, we had a really good day for market returns. And this is just driven by some maybe softer tariff expectations from the market and maybe some tariff expectations that were more targeted to specific sectors. Yeah. Now, the market took it really well. You actually saw some of the big US tech names that have had pretty poor start to the year. You actually saw them do really well initially. And we also had some US data that came through. So we had PMIs, which are Purchasing Managers Index, which is essentially a survey that goes out to businesses. And we saw it still be really strong within services. So that's a positive. Roll through to Wednesday, and we get the tariff announcements on autos. Now this is for your cars and your auto parts as well. Now looking at the countries that this is likely to affect, it's looking like the biggest sort of imports you get in the US in terms of autos come from Canada, Mexico, Germany and Japan. So these are sort of the countries that we were looking at, and we did see some market volatility, so equities maybe just a bit weaker on Wednesday, Thursday, just following this tariff announcement. What I would say is, we are multi-asset investors. Yeah. So if you think of an asset like gold that's hit new all-time highs, probably following this sort of geopolitical environment, we do have positions in gold in our portfolios. We've got the underlying managers who've been incrementally adding. So we have had things that have worked in the portfolio for us.
Thanks, Joe. And quite a bit to get into there. I suppose, tariffs is creating uncertainty. It's making analysts and economists adjust their expectations for economic growth in the US, but also globally, but also what this may mean for inflation. Higher tariffs should mean higher prices, and that's what's expected to come through on the auto side, which is expected to be implemented next week. There is still scope for some negotiations. Next week will actually be quite an important week in terms of reciprocal tariffs being put on from the US around the world. I suppose where we have seen weakness, looking over the last week's returns, is in the likes of Europe and Japan that have a higher proportion of auto companies in their index. So that is correct. That's where we have seen weakness. But we've also seen positive returns in UK equities, US equities, and in some emerging markets. So you do bring out the good point of we are global investors, and that really gives you the benefit of diversification, and that's certainly been evident this week. When we look at bond markets, we've seen bond yields fall in Europe, which means prices higher. UK government bonds unchanged. Gold, as you pointed up, was also higher. So volatility, of course, is unnerving. But it's just important to, in times like this, just to take a step back, have a think. The portfolios are diversified across different asset classes, and that should give some comfort. If we perhaps turn focus now to the UK, quite an important week for the UK. We've had inflation data, some data on the growth front, but perhaps most important was, or of greatest focus for investors, was the spring budget on Wednesday. Joe, can you talk us through any highlights and takeaways that you've picked out?
Yeah, I think two key aspects that we look at certainly will be sort of your growth and inflation expectations coming through. Looking at the growth expectations, actually for this year it's been halved, so it's now 1% expected growth for 2025. For the subsequent years, their estimates are actually increased. Which it is positive. We actually had a retail sales number come through this week, which was higher than expected. So, there maybe we could see that growth actually come through this year potentially, but the estimates have been revised down. If we think about inflation, again, it has been sticky. We know that it's expected to peak around 3.7% in July, and then come Q2 next year, expected to be back at target at 2%.
Yeah.
And we did have an inflation reading out this week, which the government would definitely pleased to hear about, and that is it came in at 2.8%, slightly below the estimates of 2.9.
Yep. So quite a lot to unpick there. I suppose thinking about the budget, the problem is that the government has been borrowing too much, and what they've been borrowing and spending hasn't gone into productive areas that's generating meaningful growth, and that's just a continued problem. So in the autumn budget last year, they increased taxes, pledged to spend more money. This time in the spring budget, they're actually pulling back on spending commitments. So it is a problem for the UK government and the future growth expectations. There is some forecasts for the next few years that suggest that growth is going to be improved, or see stronger growth rates come through, but there is some doubts to the reliability of those projections and the expectation that productivity growth will improve. I think some investors are certainly challenging that. I suppose from a market perspective, what's quite encouraging is that the gilt market's been relatively well behaved, so it's hadn't had too much of an issue with the details from the spring budget. On the inflation front, as you highlighted, it is a positive that inflation surprised to the downside. The ongoing challenge for the UK is services inflation. Services inflation remains really sticky at about 5%. So expectations for interest rate cuts this year is still relatively limited. I still think they're pricing about 2 or 3 interest rate cuts for the rest of this year. But as you mentioned, on the growth front, the retail sales, whilst sentiment appears to be quite low, consumers appear to be spending, which is a real positive, and that will feed into the growth data, as you mentioned. Let's just finish off on just some data that came out this afternoon on the US. Inflation, which has gone a little bit into the background given all the news around tariffs and on economic activity. Inflation, what were the details, Joe?
Yeah, so it's core PCE, so that's personal consumption expenditure. Yeah. It's the one that the Fed uses because they see it as the most reliable. Yeah. It came in at 2.8%, which was actually a bit higher than the expected level, which was 2.7%. Yeah. I mentioned the services strength earlier, and you mentioned it there with the UK. That's really been what's been driving that slightly upwards. I mean, it's only a marginal, it's only marginally higher than what was expected to come through, but still higher nonetheless.
And I suppose, looking at how the market's responded to that, is actually bond yields have fallen, so that's prices higher. So actually the market's saying, yes, it was a little bit higher than expected, but not concerning. And so bonds taking that well. Thank you very much, Joe, and thank you all for watching. That's everything from us today, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.